I think that penetration right now is around 15–16% of the category on our estimate of about a $50 billion market, which is a bit lower than the company's. And we could probably see that double over the course of the next 5 to 10 years.
And yet Chewy has to compete with not only Amazon, but Walmart and Target and other specialty retailers. How does it differentiate itself and still maintain margin?
Right. So its differentiated platform is one that offers extremely good customer service, almost like you're going into a pet store. You can get information online, or you can get information from specialists that you call on the phone. In addition, they have a very wide assortment of products, one that you can't find in all stores. At the same time, delivery is fast and efficient. You can get product when you need it within 1 or 2 days, and you can have it delivered to you monthly, so you don't have to worry about going to the store and lugging home the pet food that you need.
The company recently increased its first auto ship order discount to 60% from 30%. Now that discount declines as you keep moving forward, but do you have concerns about its profit margins if it has to continue to offer those kinds of discounts to compete with Amazon?
Yes, I do. 60% I think is extreme. They put on a 60% discount for first auto ship orders, really in response to Amazon's Prime Day offer, which was 60% off first subscribe and save orders. They've since taken that discount down back to 30%, which has been the norm for the first part of this year. So if we see them have to compete with Amazon, which is now running 50% off, I think that it will eventually impact their margins or impact their ability to grow customers.
When you compare Chewy to other retailers that are really attempting to break into this e-commerce environment, I mean, Bed Bath & Beyond, you cover Restoration Hardware, Lowe's and Home Depot as well. Do you see that that is an ongoing struggle, that in order to attract new customers, in order to somehow compete on delivery fees, that you're going to see shrinking margins or tight margins?
Right. Across the hardline space, we've seen a lot of margin compression over the last few years, particularly in home furnishings, driven by Wayfair's entry into the category. If we look forward, I think we'll also see pressure on margins from hardline retailers in the space of pet products. Now, these aren't publicly traded anymore, such as PetSmart as well as Petco, but we do believe their margins have come under some pressure.
I want to ask you about Lowe's and Home Depot, too. We got some new housing numbers this week. Does it change how you see the second half of the year for these home supply companies?
Home Depot and Lowe's, I think, are struggling a bit more than they have in recent years. And I think it's primarily driven by the macro factors. The slowing housing market in late 2018 and into 2019 has led to a downdraft in demand for home improvement retail sales.
And if we see refinance costs lowered because of a lowered Fed rate, do you think that that changes? People will refinance to go in and do some home improvement?
Certainly. Lower interest rates help drive housing, help drive refinancing. There's usually a 6 to 9 month lag between the time of changes in rates and the impact on home improvement retail sales.